So, welcome to the webinar, Markets, Mood versus Reality. We wanted to have a conversation today around what's transpiring in the markets. Obviously, there's some geopolitics going on, and some things aren't translating into what we see with our eyes into what's actually going on in the markets. So we wanted to talk about that. Damaris and I are advisors here at Brand Asset Management Group and are looking forward to tag teaming this conversation on today's events. Before we get started, we should at least give you a fair warning and disclosures. Past performance is no indication for future success. We can't rely on that. None of what we talk about today is actually investment advice. And secondly, we are actually using some AI tools in this event, and they helped us with this presentation. And so, without further ado, I am going to transition our conversation over to Damaris. She's going to talk about the mood in the world today. Damaris, what do we think?
Yeah, thanks, Tim. Well, I think as everyone knows, we've seen a lot of headlines this year. And when we thought about this presentation, we really wanted to start with kind of an overview of where we've been, all the ups and downs that we have already witnessed through the first half of the year, and then kind of continue on about, potentially where things are at this point. This first slide in January 2026, people started getting concerned. And in hindsight, this doesn't feel like much of a big move, but there were some really significant sells off from some of those AI leaders, those names that have really been driving a lot of the market growth. And so that was kind of the first, little dip that we started to move through. Moving into February, Iran war. So we've obviously seen quite a few stops and starts with this, but the news initially was quite a shock to the markets, to people in general, but really just caused, again, some fear, some concerns, some weakness, and that is kind of continued on based on whether the news is good or bad day to day. I think the important thing to highlight about this is a lot of the volatility, a lot of the concern is really centered around this small little area, the Strait of Hormuz, and whether or not ships are getting through, because that area is a really major transportation point for oil. And so what we see here on this slide is starting with pre-war February of 2026, average price was $2.96. The peak around May 21st, we're up to $4.55. Really, really significant jump. And for people who still have to drive and go to work and gas up their cars, that increase in cost is really a big deal. Now, the prices have tapered off a little bit. But really, it just it depends on the day. Sometimes it feels like what we're paying for gas at this point. Now, I think what's really interesting when we think about mood, right? That's one of the words in the name of this webinar is the mood. And when we think about mood, we're thinking about consumer sentiment. That is something that gets measured. And what we see in this graph, which is really, really just interesting, is these different decades, time periods of consumer sentiment. How are people feeling? And what we see here is the 2020s so far at 66.4. Some of those other time periods have been higher. And now consumer sentiment is 49.5 on this measurement. And what that really is interesting and illustrative of is the fact that, remember, we were going through a pandemic just 5-6 years ago. We were all dealing with the entire world being shut down. We were learning how to use Zoom for the first time. We were talking to our loved ones and, standing outside windows. And I got married during that time and we didn't have anybody at our wedding. That was a major, major time of change, uncertainty, fear. And what we're seeing now is that consumer sentiment is below those levels. which is just really, really fascinating. You might say, well, why? Some of the things that play into this are this new term that's been coined, the K-shaped economy. The K-shaped economy is really referring to the idea that people at the very top, income net worth wise, are really doing fine. People in the middle, they're kind of having a tough time too. And people really who are experiencing the most challenge in the season are the people who really were maybe paycheck to paycheck to begin with. So when you talk about, oh, you're having to spend, maybe twice as much or a third as much to buy gas, that eats into money that was already being allocated to something else. So this chart is illustrating on the left, the top 10% of households here with cumulative spending increases of 62% over this time period. And then when we look at the right on the chart, what we see is everybody else has kind of experienced a 30% increase in spending. Now that matters in the context of the chart on the right, which is showing that inflation has increased that much over time. So that red bar showing that increase in inflation, that's basically what people have had to increase their spending. People are not really spending more, buying more. It's the prices have gone up to the level where they're kind of equivalently spending the same amount and getting the same amount of stuff, and they're just paying a lot more for it. And that is where some of the consumer sentiment comes in. People just feel very stressed, under pressure, and that creates some of that worry.
And real quick, back on that slide, if you think about where inflation is at right now, we're hovering around 3.5%. That's on an annualized basis. The Fed's target is 2%. So ultimately, they want to try to get back to 2%. The challenge isn't so much what inflation is in 2026. The problem is what inflation was in 22, in 23, as we're working our way up. And this chart on the right is showing cumulative inflation of the last 4 to 5 years. That is what is pummeling the average consumer. And if we look at comparisons to other kind of 4 to 5 year periods of time, it's one of the worst in history. And so you're feeling that rivals some of the booms coming out, or some of the challenges coming out of various war periods, challenges coming out of various oil shocks in the past. And so this is a major problem that, again, going back to why I see markets at 7,600 on the S&P 500, and yet I feel terrible. How do these things match? This is one of those things where the mood is arguably negative.
That's a great point, Chen. So the next thing we think about is AI, which has obviously created a lot of just interest, buzz. There are real drivers behind what is happening with AI, and those companies are certainly the drivers of the market recently. Now, what this slide is illustrating is when we're thinking about, okay, we have new technology, does that displace jobs? And it seems like for the most part, based on the data, that we can see that those job losses may be accelerating in the tech sector. And then below in the chart at the bottom, now we did have a little bit more of an optimistic report in the spring on jobs, which is good news. And it seems like, generally speaking, across the entire economy, it may be more of a perspective of fewer new hires. We're not necessarily creating new positions or bringing new people in. We're waiting to see how everything shakes out, rather than mass displacement or firings, which again, I mean, not to harken back to COVID another time, but that was a very significant experience within the economy where a lot of people could not work and lost their jobs and all of that. So just kind of interesting. I think we also have kind of an interesting point here too, with this bar showing recent grads who are experiencing higher unemployment. I mean, it's just honestly kind of a tough time to be seeking a job as a recent college graduate. Obviously that's probably not true across every single industry. AI still can't fix your sink. You might still need to call a plumber and an electrician, people in the trades, right? But there is definitely a little bit of concern there. Did you have anything else you wanted to add on this one?
Yeah, I mean, the only thing I'd add is actually there was a data point that came out I read today, the lowest weekly unemployment claims since 1969, which is pretty remarkable to see. It kind of supports this low fire, low hire type of environment that we're in. And I would say as business leaders are just trying to navigate, what is AI going to do? What it is a technological revolution. What is it going to do in this next 5 to 10 years? We'll see. The whole point of what we're trying to, and I should pause real quick. We have Q&A. I've got Q&A wrapped up on my phone here. Feel free to chime in with a question at any point in this conversation. We are going to leave some time on the back end to be able to speak into some of those questions that you might have and work to answer them to the best that we can. But what you saw there in the prior slides is, all right, there's rockets launching in the Strait of Hormuz, rockets launching at ships. You've got Houthis launching rockets. You've got inflation that is top tier in terms of cumulative inflation over a period of years. You've got a K-shaped sort of economy. You've got AI and the questions around what is that going to do to the job market and the next 5 to 10 years of society. And so when you read in the news that everything in the news you read is bad, how can I connect that to markets at all-time highs? And so at the end of the day, let's talk about that. Let's talk about a little bit of the history. And so you'll see here, this is from January 23, returns all the way out through the highs of July. And so it's nearly doubled since the market. This is the S&P 500, the top 500 companies in the United States, is up nearly 100% in roughly 3.5 years' time.
That's a
pretty remarkable. Pretty remarkable. And so when you just look at even this year, S&P 500 is up almost 10%. Again, give me some grace on this. This was over the last couple of weeks. Obviously, if you're looking at the markets today, it's a little bit more challenged. But the S&P 500 is up nearly 10%, forgive me. The Russell 2000, which is small U.S. stocks, up 20%. International, large companies up nearly 10%. Emerging market stocks up nearly 21%. It's a pretty remarkable run. And so this year alone, the run that we've had, now let's put that in context into prior seasons of extended returns. And this is giving you a little bit of historical context for that. So the period of 2022, again, going back to what we feel and what we're seeing with our eyes, how is the market doing this? This 3.75, 3 3/4 year runs, annualized returns of roughly 21% is rivaling other boom cycles, a la the dot-com challenge. You've got some bull markets in the 80s that you're experiencing, obviously the post-COVID recovery. But again, we're hearing a decent amount of connections between the experience that we've had in the last 4 years to the dot-com crisis. And a lot of clients are asking us or connecting dots to the AI bubble, dot-com bubble. I've lived through the dot-com bubble. Are we just going through another one of those right now? And we've got a few charts to speak into that a little bit. So if I connect the last 3.5 years or so of price-only data, that's the green bar right now. That's our current cycle. The last 3.25 years of returns in the S&P 500 is almost on parity to one of the last 3.25 years of the dot-com crisis starting in 1996. And so when you look at the price-only feature, your eyes are telling you, yeah, it's pretty darn similar, which is then we all know what happened coming out of that boom. There was a nice little malaise/bust for a 3-year period. But there's a couple differences that are going on in this cycle that we're experiencing now with AI if we look back in the exact same experience for the dot-com crisis. And the first one is multiple expansion. So that's just the price to earnings ratio, which is just communicating how much am I willing to pay up for a stock for $1 worth of their earnings. Typically, the higher the price to earnings ratio is communicating the possibility of overvaluation or a rich valuation, which isn't always necessarily a bad thing if earnings back end that over a period of time, right? The market is a forward-looking mechanism. The market is placing assumptions, bets, if you want to call it that, or reasonable analysis based off of what we think the future will unfold. And there are times when people will be willing to pay up for a stock and the earnings back into it that works out. If the earnings do not follow it, that's where you can run into a series of corrections. And so one of the challenges in the dot-com crisis, which isn't as significant of a challenge in today's environment, is multiple expansion. You can see the price, what we would be willing to pay for a stock in 1998 or 1999 was so high that the earnings couldn't substantiate that. And that's where some of the trouble came into on the downdraft. We're not quite at that point in terms of price earnings. I'm not here to tell you that stocks are cheap right now. I cannot logically communicate that stocks are necessarily cheaply valued. I could say that it's a richly valued environment. That doesn't necessarily mean a course correction is in order imminently. It also is communicating we're not quite at the point where the dot-com crisis was. Additionally, the next factor, and this is one I would argue is more important. The dot-com crisis, you could raise $1 billion if you slapped .com on the back of your name. We are with no earnings that was behind it. This environment, we are seeing far greater earnings power behind some of the hyperscalers, behind some of the businesses that are supporting more of the stock rise in the equity environment right now. You can see the dot-com crisis was far lower than the run that we're seeing right now. We're seeing a lot of up and to the right movement in earnings per share in the S&P 500. And we've got more charts to show you that, as well as the broadening out beyond just the Mag 7. The Mag 7 are just basically the hyperscalers, the ones that are experiencing a lot of this AI revolution and exploring more CapEx into the AI revolution. We're seeing earnings continue to perform really, really well. And one of the people that I love to read is a guy by the name of Ben Graham. If you've heard of Warren Buffett, which we all have, Ben Graham was his teacher back in the early 1900s. And one of my favorite quotes that he has is this one right here. In the short run, the market is a voting machine. In the long run, it is a weighing machine. And what Mr. Graham is communicating in this is, in the short run, the market is going to vote on, are rockets going to continue to launch? Is Russia-Ukraine going to get solved? What about this upcoming election that we have for Congress? Are there going to be material changes in laws? Inflation is up, inflation is down. Kevin Warsh is elected as Fed president. He's not. What are these hyperscalers going to do? Is AI going to eat all of our jobs? Those things are voting things. I'm going to bet, right or wrong. But in the long run, and that's the thing that matters for longer term investors, what are earnings doing? Stocks are going to move higher or lower based on the underlying earnings that are delivered to the shareholders, to the owners of that company. At the end of the day, earnings are what matters. And that's where Damaris will chime in and share a little bit more data regarding the earnings environment that we're experiencing this year.
Yeah, thanks, Tim. So this chart here, as we're talking about now getting into, we talked about the mood, we talked about the markets. Now we're talking about the reality. And what we're seeing is earnings continue to deliver. So in this chart, we're looking at the S&P 500 price over time, and then also earnings per share as well as an important data point there. So when we're looking at this, we're saying, oh, well, I mean, yes, there are maybe some things that could give us cause for concern. But again, another data point that earnings are keeping up with this. And I think that's an important thing to be aware of when we get a little nervous about what this feels like from the past. This is another chart that sort of illustrates that point as well. It may be a bit hard to see on the slide, but this gray line with the dots, that is the average. And then below that, we've got the median number. And that is the historical average then in the historical median. And what we're seeing right now, again, with earnings is that they continue to deliver both this year and then projected into next year, also beating that average. Do you have something you wanted to add here?
Yeah, I mean, look, Q1, again, how in the world are we at 7,600 on the S&P 500? Well, Q1 earnings were 25%, roughly, give me some grace on that, roughly 25% year-over-year earnings growth. That's nothing short of remarkable. And what we're showing you here is, well, what's the average? Like if I knew if 30 was the average quarterly earnings growth, then I wouldn't feel so great. But if 15 is the average quarterly earnings growth, then I'm looking at 25 and I'm thinking that's nothing short of remarkable. That's an unbelievable quarter for earnings. And we're forecasting the market is forecasting 23% earnings growth for Q2, 27% earnings growth for Q3, 24% for Q4, and year over year earnings growth on an annualized basis of 24% when you're sitting in an average of 15. Again, going back to it, in the short run, the market is a voting machine. In the long run, it's a weighing machine. These earnings, if delivered by year end, are remarkable and supportive of a continued run in the bull market. Now, what we've seen is we've only seen Q1. And again, the market is a forward-looking price mechanism. It is assuming continued earnings growth. There are things that can disrupt that. We'll talk about that in a bit. But in terms of the market consensus, really strong year-over-year earnings growth that are supportive for the rise in stock prices that we've seen, with an expectation for even further going into 27.
Yeah. Oh, this is probably my favorite slide of the entire webinar. And I think why I really like this is because last year and early into this year, we were spending so much time talking about the Magnificent Seven, the basket of those 7 names that we could not stop hearing about, Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. And what I heard from clients, what I think we all were thinking is, when you go out and buy the index, and it's an index that is weighted to the proportion of the market, you purchase that, and these names are becoming so much of that total index that you have a lot of exposure to them, whether you really like it or not. If you're just buying an index, that's what you're getting. And so what we are demonstrating here with this slide is that there is a broadening taking place now. Where we started on the left side is the Magnificent Seven really are taking up a really large portion of that. And then as you sort of move through time, we're starting to see the S&P 500X Magnificent Seven. So everything else is increasing. And that feels like some good news. And also maybe a little bit of a pullback on some of the risk or the nervousness that some people were feeling about what those 7 companies were doing. And then to illustrate that a little further, here's a lot of numbers on this slide. But I think what we wanted to show here again was just a little bit more data to back up these points. Did you want to go through this?
Such a busy slide. We'll focus our attention. Green is good. Red is typically bad. And what we're seeing on the right side of the page is a healthy amount of green. I want to focus your attention to the far right and basically communicating full year 26 earnings. So this is earnings by sector. Taking a look at consumers, discretionary, consumer staples, energy, financials, healthcare, industrials, and so on. And the parts of the far right I want to focus your attention on is some of the outliers. In particular, energy. Energy with fiscal year 26 earnings growth of over 46%. You've got materials at 38%. You've got technology at 48%. You've got utilities at 11%, which doesn't sound like a large number, except when you look at history. And so what are we seeing in some of this underlying data? Well, what we see in some of this underlying data is how much of this is related to just the AI build out. Now, arguably the energy sector, that's a little bit of an anomaly just given what's going on in Iran. And you're seeing obviously that Q1 versus Q2, a significant jump in earnings coming out of that. And I would suspect some of that has to do with Iran. But when we really look at those sectors and in each asset class, so to speak, there is a lot of focus on the AI build out. So now let's talk about that. We've got mood, which feels bad. We've got markets, which are incredible. Well, what's substantiating some of that? And let's start to build out a bear and a bull case for what's going on in one of the larger pieces of what's going on in society and frankly, the world, artificial intelligence. And so let's take a look at the next couple of slides here and you'll see they're just striving towards the future, AI. One of the bigger things you're seeing, and if you paid attention to any earnings reports this morning, you saw Tesla and Google report earnings. And the markets did not take too kindly to some of their reports. And a lot of it had to do with what they were spending on CapEx. CapEx is just capital expenditures for a company. They're basically taking cash that they have earned and they're sowing it and investing in it to something that they expect to deliver a better return in the future. And that is artificial intelligence. They're creating data centers. They're creating energy infrastructure. They're creating the systems to deliver artificial intelligence. And this chart is just communicating how significant these hyperscalers are folks that are trying to spin up artificial intelligence quickly. And think of Meta, Alphabet, Microsoft, Amazon, and a few others here and there. But the overall projected spend in 2027 is about $1 trillion. And so nothing short of remarkable in terms of that money that is flowing into the system. Now, there are pros and cons to that. We'll start first with the bear case. And I'll pause real quick. I haven't seen any questions come through yet. Obviously, this is a data-heavy presentation. We're dumping a ton on you. If there's any questions, just a reminder, we'll answer some of those at the tail end of our presentation. So let's start first with the bear case for for artificial intelligence and some of the CapEx specifically. So is it just circular? It's one of the questions that you'll see posing a lot. And an example of this is, all right, well, NVIDIA takes some of their free cash flow. They're selling chips and they're taking earnings. Well, they're going to take $100 billion of their free cash flow and they're going to send it to OpenAI. And OpenAI is going to have some cash flow on their books, and they're going to take that, and they're going to take $300 billion, and they're going to send that to Oracle. Oracle, in turn, is going to take that and buy chips from NVIDIA. Help me understand how that is organic growth to the overall society. Doesn't really make sense. Same is true for Microsoft and OpenAI. Microsoft actually owns a portion of OpenAI. Well, what does that make? Does it make sense to you that Microsoft would buy from OpenAI, who in turn uses their cloud service through Azure? I don't know. Maybe. Sounds circular to me. Amazon, the same thing with Anthropic and AI, and Google, the exact same thing with Anthropic. So there is a very serious question around this. And oddly enough, I played around with Anthropic in the first quarter I played around with Claude. It's an AI tool that we have and that we use here at Brand. I was posing some questions around how much of first quarter earnings growth was just related to these circular types of deals. And there was roughly half of earnings growth in Q1 was connected to a lot of these deals here. And so there's some question marks around that. Is it just circular? We'll see if more organic growth comes to stocks. The other side to it is it's not just specifically circular deals like this, but we have to have the infrastructure to be able to support AI. It requires a healthy amount of data centers, of energy, to operate a data center, to be able to support the software need on AI. And so right now in America, we have 1,200 operating data centers with 55,000 megawatts of operating capacity. We've got another 1,700, so double what we have right now in planned data centers to be able to support the AI build-up. Well, I'm sure you're reading the news and seeing local newspapers communicate, I don't want that data center here. I think President Trump actually released a statement today. Basically, if the data center's going in, they got to pay for their energy. There's a lot of local communities that are pushing back on some of these things. Well, a risk to the CapEx expenditures that a lot of these software companies are putting out, a risk is we don't have the energy and infrastructure to be able to support the need. All right. Well, that's one risk. Another risk that is one that we're seriously questioning is, are the productivity gains enough to justify the spend? It's high. Arguably, I don't know if many folks really know, truth be told. This is a technological revolution. This is something new. And society is, to some extent, figuring it out as we go. But the question mark is, are they enough to justify $1 trillion of spend in 2027? Are we going to get the return on that investment? Obviously, Meta, Google, Microsoft, they believe that. But there's some early indications. Yes. So there's no doubt in my mind that artificial intelligence adds to productivity and does also add to a better ultimate output. There's no doubt that that does happen. However, does that happen across all of society? is artificial intelligence, to Damaris's point earlier, is artificial intelligence going to be the plumber that replaces the drain? Is artificial intelligence going to replace a semi-truck driver? Obviously, Tesla's working on that, but is that 5 years from now? Probably not. Is artificial intelligence going to build the truck or build the train? All of those things. That's why when we look at the entire whole of the economy, a Nobel laureate's estimate was that over a 10-year period, again, this is an estimate. Does he know? No. Is he going to be wrong? Probably. I think anybody that puts a reasonable estimate together, if you put it broad enough, you're going to be right. But if you really dial in, it's hard to say. His estimate, one person, is about 0.5% to 0.7% increase over a 10-year period. Is that enough to justify it? Maybe not. The other side to it is the next chart will communicate the potential return on investment. And so the green line here is communicating what the market is pricing in for earnings coming off of these companies. And if that doesn't pan out, you can see a repricing risk. Which is communicating, you can see a correction in stocks. You can expect to see a correction in stocks. If earnings do not keep up with what is expected, you can expect to see a correction in stocks. And so I'm bad cop today, communicating the bear case. This is a risk. There's a few risks. There's multiple risks. We've got 45 minutes for a conversation today. There's several risks on that side. There's several world risks that are going on. This is a bear case with a few data points. Damaris is going to be good cop and talk about the bull case. There is another side of that equation, which is driving. If Google is spending a fortune building out hyperscaler, building out AI, they probably believe in it. Let's talk about the bull case.
Yeah, that's a great point. So as we start to think about, okay, so we just heard some potential negatives, potential cause for concern. But as we think about this topic as well, there are a lot of things that we can point to and say, well, this could be really a big deal. And so as we're looking at this chart, where we're going through the data here, is there's potential for significant free cash flow. That is what FCF is standing for in this on the horizon. So in this slide, consensus is expecting, again, today's AI capital expenditures, the money that we're putting into it, to translate into surging free cash flow. So what this is saying is these companies have been, taking this free cash, they've been deploying it back into what they are doing, which is good. We probably want them to be doing that in this phase of growth, significant growth. However, there's probably going to be also come a point where they've really yielded a lot of that additional increase in investment, and that has really paid off, and that starts to go out, not being invested back into the company, going out. And so that could be a positive experience, certainly. That would be farther on the horizon. And then the other thing is, okay, so, Tim said there are a lot of things AI can't do. I agree with that. My brother is a firefighter. I don't think AI is going to be putting out fires anytime soon. However, there are documented productivity gains. I mean, anecdotally, we see that here already in some of the things that it can assist us in doing that provide the same good experience for the client, but allow us to be more productive in the things that truly matter. What this chart again is showing is these documented productivity gains. You've got customer service reps. You've got software developers as a very high percentage on this. This was a specific field study with GitHub where they experienced those really significant productivity gains. And then generally speaking, management consultants too. This was something I think that came out of Boston Consulting Group, again, with a much higher quality in the output and also increased productivity. And so there are considerations for that too, right? How can AI not just make us more productive, but also in this knowledge work or some of these white collar fields also improve the accuracy and also improve just the overall output that comes from a person in their employment. Can you say on that?
Perfect.
And then
this is my favorite chart.
This is Tim's favorite chart. So looking at this and talking about tokens, and if you're not familiar with tokens, it's kind of the measurement of capacity. Would you say that's a good way to describe it? So for example, we use Claude too much here in one day. It said, oh, you're going to need more tokens if you want to do more stuff with it. But where we're looking at this here is 2 years over the token price and volume. And what we're looking at on the left side, token price, token volume. Token volume is up 100x. Token price now is actually down 10%. So what we're seeing is also over time, the cost for this, for the additional computing or the additional power out of the tool has gone down and the usage has gone up, which feels, again, completely anecdotally true for what we've experienced.
I just like, if you are worried about, and again, this is bull and bear case, we'll see what happens. Like I'll have 2020 vision on 2027 and 2026 when it's 2030. Right now you're in the build up phase. But some of the indicators that are communicating, all right, this isn't bad, is one, token volumes, which is just, again, the price for compute is falling. The demand for the compute is rising significantly, exponentially. And there's a few indicators. So electricity, again, the grid, we need power, we need infrastructure to be able to service the demand for intelligence. Utilities and grid operators are projecting usage to double from 25 to 2028 in 3 years. In 3 years. Why do you think we're talking about nuclear, solar, oil, all of it? You need the energy to power these things. The other side to it is Azure, which is just Microsoft's cloud-based system. It's a place to store data. They can't fill an $80 billion deal not because of demand, not because of the demand for the intelligence, but because of electricity constraints. Again, that was part of the bear case we mentioned earlier. But if demand is seemingly limitless for intelligence, it's an interesting thing as humanity. But demand is very, very strong, which is supportive of the bull case. Again, just real quick, going back to that free cash flow chart, just thinking through the cash flow for these hyperscalers. If you look at that, that is nothing short of incredible. So think about the Google and the Tesla earnings call today. Their stocks are off significantly. Last I looked, Tesla's stock was off about 14% this morning. If you're looking at today in isolation, you feel terrible. But if you're looking at what these hyperscalers are thinking for free cash flow that is 2, 3, 4, 5 years out, you're looking at a significant investment. They are taking cash and investing it in something that they think is going to deliver a significant return years into the future. We'll see. Right now, in the period that we're in, we are experiencing a whole bunch of earnings calls. So as I mentioned a second ago, all of the big banks reported last week. We are seeing a lot of the software companies report right now. Got that one. And then, so you're seeing big tech reporting from 2027 to 2030, July 27 to 2031. Google reported today, actually. And so you can expect a little bit of volatility potentially during this season as earnings are released. Again, in the short run, markets are a voting machine. In the long run, they're a weighing machine. The last part that we really want to communicate at the end of the day, we're sitting here as advisors, and one of my favorite statements to make to clients is, I'm famous for talking out of both sides of my mouth. On the one side, I'm remarkably positive on the things that are going on in some of the new intelligence fields we're building, the infrastructure we're powering. I'm remarkably positive on that. On the other end, there's a lot of negative going on in the world today. And how do you always marry that? I'd argue 2026 is the same as every period that came before us. There's always some level of good. There's always some level of challenge. And this is just a historical chart of the S&P 500. You can see over the long run, stocks typically go up and to the right. Not typically. Stocks go up and to the right the longer we look. But on an annualized basis, we don't know entirely what we're going to get. And every year, looking back through history, on average, you can expect a 14.2% decline from peak to trough at any given point in the year. That's average. So when we see a 10% decline or a 15% decline, you're going to see journalists freak out. You're going to see a lot of publications try to knock you off. And the truth is, if you called us, we would tell you, well, that's average. And if it's 10, that's better than average. That's normal. Volatility is normal for an equity investor. We are looking to the future that is entirely unknown. On average, 14.2%. So it's just a reminder, as we talk around the mood of the day, consumer sentiment is terrible. Inflation feels awful. I'm paying more for a gas of gasoline or diesel than I've ever paid in my life. And that is taking from my vacation money or my daycare money or whatever it is. You've got all of these challenges that are going on. And at the same time, we see stocks rising to all-time records. It's remarkable what's going on. It's just a reminder that even in great highs and great challenges, stay very disciplined to a structure. We do not invest based off what we think is going to happen. We define a structure that is based off of our risk and return profile that makes sense of our goals, our cash flow needs, our time horizon, and we stay disciplined to that structure in the good and the bad.
I'd like to add a couple of things too, just in conversations with clients and observation reading headlines. It is very interesting to see because in a historical sense, we had, tough year in 2022 in the markets. Then 2023 was good. 2024 was good. 2025 was really good. 2026 has been good again. And so you think as people who are investors, that feels good. That feels exciting. We're seeing, sometimes double-digit returns halfway through the year. The reality is, and I think this is just something psychological about us, when things are going well, we find things to be nervous about. When things are going poorly, we're worried. And so some of this too is if reading the headlines and seeing the ups and the downs and the all arounds, if that causes nervousness, anxiety, worry, there's something to be said too for we've been through a lot of seasons like this. And when we're coming off of the backs, at least of 4 good years, there's a lot to be grateful for. The other thing I'll just say briefly is those of us who are in a position to be worried about what the market is doing are privileged. Because as we talked about with the K-shaped economy, people are having to make hard decisions between what they're spending money on, whether it's, gas or groceries or doing something fun with their family. And so just, again, being sensitive to that too. Yes, we talk about markets. We love them. This is what our job is. But also being sensitive to rising costs that are impacting people in very real ways. Staying disciplined, that's the most important thing as an investor. And anyone who works with us has heard us say this over and over ad nauseum. Pick the right allocation, stick with it in the good times and the bad. And we know that works. So
I don't see any questions. I'll give it 15 seconds. This was the last slide that we wanted to present. Again, stay disciplined. If there are no questions, naturally, you all know, feel free to reach out at any point. We are here to serve each of you with discipline, with excellence, and love you. And so we appreciate the opportunity to share some thoughts with you today. We will continue to expand on these webinar series, explaining the markets, explaining our thoughts, and we'll keep striving towards better every day.